Hey guys, Austin Schneider here, and if you are in the process of getting a home, you may have heard the term called a point. So a point is a fee paid to a lender either at closing, or it can be paid over the course of the loan, but you will have a higher interest rate. What we're gonna do is we're gonna give you some ideas of when you might want to pay the points up front, or if it may be best to spread it across the loan and have that higher interest rate. So you may want to pay the point up front as a part of your closing costs if you plan to own the home and live in the home for around 5 to 7 years plus. The reason we say that 5 to 7 years plus is a good kind of stopping point for you, a good marking point for you, is because if you pay the point up front, it'll reduce your interest rate throughout the length of the loan, which will just make it easier for you to enjoy that low interest rate while you're living in the home. One reason not to pay the points up front is if you are planning to live in the home for 3 to 5 years, it may make sense to spread the points across the length of your loan. And because you won't be in the home that long, you're probably not going to recoup the cost from the higher interest rate than you would if you were to pay it up front. Another reason why you may want to pay these points up front is if the sellers are paying for your closing costs. You can easily roll these points into the seller's expense versus a buyer's expense, and it makes it easier for you to have that low interest rate among the lifetime of your loan. Another reason why you may not want to pay these points up front is if you are looking to save money out of pocket when you're going to purchase your home. Because the point is a percentage of the loan amount, it is another fee that's associated with, say, your down payment. Think about your furniture. Rather, spread it across the length of your loan and forget it, and maybe refinance later down the road. Another reason why you may want to pay these points up front is if you need a lower rate to qualify. So if your debt to income ratio does not qualify for the loan, if your monthly payments are not qualifying you for the specific type of loan, if you pay these points up front, it'll lower your interest rate, which will lower your monthly payment, which will allow you to qualify better. Another reason why you may not want to pay the points up front and have it spread across is if you could get a better return on investment elsewhere with it. Totally depends on your unique situation and what the market's doing in your area, but it could also make sense to use that money in a different investment pool. And the last reason why you may want to pay this point down up front is if cash flow is more important than the initial savings. Because you'll be buying down this mortgage, your interest rates are gonna be lower, so it's gonna make your monthly payments lower, and you're gonna have more cash flow, whether that's from your income or if it's a rental property. And the last reason that you may not want to pay these points up front, rather spread it across the length of your loan, is if savings are more important than cash flow. If you want to save a little bit more money up front, have that comfort barrier for you and yourself, and not really necessarily worry about the cash flow that you'd be saving over the length, take the higher interest rate, and possibly refinance later down the road if it makes sense for you. All right, guys, thanks so much for watching. For more on this topic, visit us online at themortgagereports.com. Thanks so much for watching. We'll see you on the next one.